Hey everyone, so the stock market has fallen some more today after the Fed FOMC release, which I guess if you had watched my last video I did about the last inflationary kind of uh, issues that we had, I believe it was September 13th when the stock market pretty much took a pretty hard dive. And my kind of, I guess, takeaways is that it's not over. We still have a lot of kind of work to go through, and the Fed pivot, which is kind of where a lot of fundamentalist macro folks are saying that, hey, the Fed has to do something to make the economy better, because the government is not going to be able to afford their debt. People, stock market doesn't like any of this. Wall Street doesn't like any of this. And I think the Fed is doing the right thing as far as what their job is. Their job isn't to make politicians get votes. Their job isn't to make money for investors. Their job is to control inflation and to control unemployment and to make the kind of work environment, by some weird mandate, I guess, fair, so that work or inflationary jobs do not, or work wage increases or kind of, I guess, stagnation doesn't hurt the people, right? They want to make sure inflation is under control, so people who have no way to increase their income don't get killed by just the cost of goods. Keep that under control, and to keep the job inflation rate as far as wages low. And that's what they're doing. And the report that came out, I'll be honest, I didn't page through it or thumb through it, but it did show that, yeah, we're not only going to have a higher rate of interest rate increases, but our GDP is going down. And the GDP going down, as an estimate, as many of you folks know, usually the GDP comes in at under expectations, and it has been for a while. So we're still looking at potentially harsher or more downturn. Now, we probably will see some kind of a lift just because of how oversold we are. I'm going to say, for those of you folks who have an investment horizon, and again, this is not advice in any way, but for those of you folks with an investment horizon that is less than 5 years, what that means is you need the money that you're investing in the market today in less than 5 years. Don't. I don't know what to tell you. I don't know what a good option is for you. But the stock market is a very real way to lose a lot of money in the next 5 years. Most likely, the market will probably somehow find a bottom in the next few quarters, but we don't know how much more pain we could see. I mean, some people say that the S&P hitting at 350 is the bottom. I don't know. Could be, couldn't be. And some people say that, the S&P's real value is somewhere closer to like 200, right? There's all these people out there who have all different ways of all different formulas to figure out what is the true price of an index. Another thing to consider is that we've had in the past great returns from passive investments, right? So index investing has provided much higher returns than risk-free. So risk-free returns is the bond return, right? The bond returns has historically, over the last 10 years, been teetering between like 0 and 2%. So fixed rate risk-free returns have been low, while market returns passively, so that's the S&P, have been really high. Now, I've been saying this probably for about 4 or 5 years, but there is going to be a time when index investing isn't going to be the way to go. And it has to be, because if not, why would anybody actively invest, right? So why would Wall Street have anybody analyzing anything when you can just have algos and, you know, S&P do everything for you, right? If that was the case, then not only would it provide even more corruption because of centralization, right? Right now, if the only thing to do is invest in S&P 500, then everybody would just follow the S&P 500, and no one would be against the S&P 500, meaning that there's nobody actively going and trying to find better picks than the S&P 500, because the S&P 500 would be the only thing out there. That would cause all kinds of centralization problems, monopoly problems. I mean, if you watch The Big Short, there's a scene where Steve Carell's character goes and talks to an analyst, and he says, I don't understand. You all know this, the subprime CDOs and mortgage-backed securities. They're like, we all know it's rubbish. It's going to, like, one fall foreclosure and this whole thing collapses. And they're like, well, we can't rate it poorly, because if we rate it poorly, all these CDO companies are going to do is they're not going to use it. They're going to use someone else. So imagine now an environment where there's only one person or one company controlling everything, right? We don't want that. So active investors potentially could have a more profitable decade. And I'm not saying to go and find an active investment company or whatever, unless you want to pay a lot of fees. Hedge funds, as you know, can generate high returns, but they have high fees. What you could do is you could find stocks that you like, that you think are going to be profitable in this environment and in the environment going forward, right? I heard these, I guess you call them entrepreneurs, who have kind of insight or have put together a really good theory. And the theory is that the legacy companies, unless they have a substantial social reach, like they're on TikTok, they're on YouTube, they're on Instagram, they're on Facebook, and they not only just post stuff out there like billboards, but they also interact. Those companies that do all those things are going to be successful, because that's the new landscape for the future. It's social interaction. It doesn't have to be like the ESG social, like socially responsible. It just has to be socially engaging and build their brand through all the channels, and is not only stuck with traditional marketing. They have a face, but they also have a personality. They also have a engagement. They are interacting with their audience. Those companies are going to outperform, most likely, in the future, all these other companies. Because just take a look. I mean, Mr. Beast, for those of you who don't know, he is a YouTuber with millions of subscribers, 100 million, probably over 100 million. He opened up a burger joint. I believe he has an energy drink. You know, he has businesses that he created on top of his fame. So if companies aren't focused on building their fame socially, like people, influencers like him, then they're losing out on the way that the business world has changed. Marketing has always been about attention, and people's attentions now are on these devices. They're on these phones, they're on TikTok, they're on social media. And if that's where all the attention is, then that is where they need to go, or else who are they going to be advertising to if no one's paying attention, right? So those are the kinds of companies that I feel will do well. Now, I feel they felt, I'm not in any ways a business analyst, so I can't tell you whether or not that's valid. But to me, it makes sense. And that is where you can start to kind of manifest, I guess, your ways to invest. So this is investment now. The investment may not pay off for 10 years. You may be averaging down. You know, you may be buying a stock at 30, then at 28, then at 25, then at 20, and then your cost basis now is at 24, and boom, it shoots to the moon at like 50, right? That could happen. That could happen over the course of years. So if you are a day trader like me, who currently has, I don't know, like 8 positions, most of them on shorting energy, you know, and your trade is like maybe a few weeks, then this trade is not for you, because the market is still in pain. And for long-term investors, you need to find the companies that you think are going to be around for a long time, performing well, performing over the others. And the indices, I feel, will not return anything really worthwhile, which again then now brings into the question, what else can you do? There's a lot of options. It just really depends on understanding your own risk tolerance. Fixed index annuities are now allowing, or have great returns based on market performance. So S&P does like 3, maybe the fixed index annuity will have 120% of the S&P's return. So they'll give you 4 or almost 4, right? 3.6. Is that good? Depends, right? The risk-free return is like at like 3.92 for the 1-year treasury, so it's not good at all. But neither is the S&P. And bonds are continually getting destroyed. Bonds hit new lows today, and they're continuing to sell off, which is why I feel the market sold off today, because many analysts, and I guess both from the fundamental side and the technical side, and like the wow, this is really low even for bonds mentality, bonds have gone lower than that. And if the bond market is not subject to the kind of, I guess, hypothetical floor, you know, like bonds shouldn't go below this, then the stock market, which is a less liquid, believe it or not, there is more money in the bond market than there is in the stock market. The bond market is flushing out beyond what analysts, technical and fundamental, and regular market kind of connoisseurs think is going lower. Then the stock market will probably fall too, if that theory of, you know, your, I guess, knowledge of things are like going against you, right? From this point on, I believe it was from yesterday, that we as far as like a technical analysis kind of community have realized that the bears are in full control. So it's not just, okay, well, we're in a bear market where there's going to be more volatility and we're going to get we're going to get kind of swings up and swings down. We are most likely going to have small ups and larger downs, kind of like how a bull market works, but with bear market with full bear control. So until this kind of lightens up, we will have, at least in the short term, meaning days and weeks, a further grinding down. Now there is some relief as the elections are coming up, which should kind of influence, I don't want to say like this, but kind of influence the people who control, I guess, the mass media or the masses to prop the stock market up a bit. Because when the stock market's going up a bit, we tend to have a little bit better sentiment as far as like what the government's doing to help the people. I don't really understand why, because most people, when they look at their portfolio and it's like year to date down 30%, if it's down 35 or down 40, like, they're not going to be happy, right? I mean, my portfolio, since I took it from being passively managed till I started actively management and actively actually trading on it, has been, or is beating where I was back in March, but I'm still down from, like, you know, the December highs, because I haven't been able to battle back that far. But for the most part, I don't see how that little relief, unless you're looking like at a super short term, which I don't think many people who are voting are looking at like the last month. They're probably looking at the last year, 2 years, 5 years. So maybe if we hit like if we go above COVID lows, because we're almost there now, if we get to be above COVID lows, maybe there'll be some kind of, I guess, prop up good feeling for people who are voting. But for the most part, I don't think, I mean, you can You can quote me, I mean, I could be wrong, but I don't think that's going to provide any kind of relief on the rallying side for the stock market. So what can you do? Again, I keep coming back to this because I want to provide you with something that you can actionably take advantage of. So if you have money that you are losing, that you don't want to lose anymore, you can't lose anymore, then look at other products like bonds, and not the bond fund. Don't go and buy like TLT or HYG. Don't buy the bond funds. Buy the actual bond. So go to treasurydirect.gov, look at what they've got, look at the 1 year, the 3 year, the 5 year, and build yourself a bond ladder if you can, right? The I bonds paying 9.62%, almost 10% on a risk-free. You guaranteed this much, at least for the next 6 months. The principal is guaranteed as well. You got a 5 year lock-in, but you have a 1 year lock-in with a 5 year kind of, if you take it out within the first 5 years, they take back a quarter of interest, which, I mean, come on, they're not taking any principal, they're only taking interest. So there's all these other options that you can use. I mean, Yotta Bank, which is the bank that I use to hold my savings, they actually allow you to invest in the I bonds directly from their platform. So you don't have to go to Treasury Direct and do all that crazy login and stuff. You can do it through Yotta Bank and put in your 10,000 through there. You know, there may or may not be a link in the description below. Who knows? I don't know, because I upload these on my phone, so I might not put it in. I don't have some production crew behind me doing anything. It's just me and my car. It's actually my mother-in-law's car. I'm waiting for her dog, who's in the groomers today. And you know, it for all things kind of investing, putting money away, you gotta realize what the goal is with the money. Forget everyone who is not a professional trader, a stock market person, you know, and anybody who is not doesn't do this, and I'm not talking about people who have a financial planner. If you have a financial planner or you have a 401k, you are not an investor. Like, I mean, everyone might call you an investor, because technically, yes, you are investing. But for those of you who don't like trade and don't really understand the way the market works, you should have a lot of money, or at least a good portion of your money, out of the market in risk-free items. And you have to be smart with risk-free, because risk-free ultimately means that inflation could eat up your money. But now, I mean, the stock market risk could eat your money while inflation is still eating your money. So you have to kind of put it into perspective and say, hey, risk-free return, 3.92% for 1 year. It might be even higher today because of the bond sell-offs. That's good, right? But inflation is still at 8.3 year, you know, August to August. That's not beating inflation. That means the real rate of return on these bonds is like -4. But take a look at the stock market's return this year. It is down almost 30%, plus you lost buying power. So you're down 40% on the money in there, right? If you were to take on it like a real real basis, like the real return, right? Inflation adjusted return, you're down beyond belief, right? 40%. But I'll tell you this, in 2018, when I was still doing financial planning in a large firm, they had said that the risk to reward on a portfolio that was 100% invested in stocks was a 7% upside with a 50, that's right, 50 downside risk. That means that for a 7% gain, you are risking 50% of your money. I don't do that unless I'm trading options. And to be honest, if I'm doing that kind of a risk to return parameter, the trade blew me up, and I'm just hoping to catch like an oversold condition where I'm like, oh, right, we went so low, we're bound to bounce back a little bit, because you know this selling pressure is look like it's alleviating, so maybe I can come out with my neck over the water, right? So when I look at things, I'm like 10% risk, 20% gain. That's how I look at things when I'm investing in the stock market. But from 2018, the risk to reward ratio has been so low because of our inflated prices. And COVID, while yes, COVID took it all the way up because of the increase in monetary supply, that is not something that you can rely on. That is, I don't want to say it's fake because it's real. People did sell for 20, 30, 40, 50% more than what they bought in for. But the sustainability and the overall kind of economic effect of what the M2 increase, or the Federal Reserve Bank pushing money into the system, that is, they don't use the word fake, but that is just a kind of short-term solution to prop up the economy while the economy tries to gather itself and prop itself back up. So it's very, and unless you're a trader, unless you're a true professional trader, investor who analyzes all this stuff, we have no idea, right? You just have no idea. So with that said, I will leave you with all those wonderful thoughts. Guys, have a great week. Don't worry, in the end, we'll all be dust, and it's just money.